Okay, it's 9:59. I think we'll begin here with our usual intros, and there'll be other people joining as we go forward, which is great. Just wanted to welcome everyone to the virtual annual PAMIC Spring Conference, and we have an amazing lineup of topics and speakers over today and tomorrow. So we hope everyone leaves with not just one idea, but a few ideas maybe that they hadn't thought about before they joined. We want to first, as you can see on the screen, many of our sponsors, we want to thank all of them on the screen for their support for PAMIC, because this allows us to provide the quality education that you're getting today and tomorrow. Without them, we could not do the fine programming that we've been doing. In addition, while I'm an education chair, it takes a village to put on these events, and we're very lucky. I wanted to introduce the folks that are helping to put this one together, and also in the future are probably our executive roundtable. It's Chris Ayersman from Hartford Steam Boiler, Kevin Finn from Mutual Capital Analytics, Thomas Brenner from Caldwell and Kearns, Sue Quimby from MSO Incorporated, Evelyn Schrantz from MMG Insurance, Melissa Tomanino, Morgan, and Atkins. We have some, with many of the virtual conferences, as you know, there's some items, especially if we're collecting CE, which we are. There'll be polls that'll be popping up twice each session, because that keeps us in compliance with the filed states. So please answer the question on the screen to make sure that you're in compliant with the CE. I don't know what the questions are. They could be silly ones. Is the sky blue? Yes or no? I think they're that easy. I don't know if they put anything like, do you like Ron Gallagher or not? But hopefully you put yes if that's one of those questions. But anyway, be alert for those, and everything will go smoothly following the CE. There'll be the CPE certificates we sent via email at the conclusion of the conference. Also, anyone that needed general CE credits should have provided their license number upon registration. If you didn't do that and it's missing, then you should email Andrea at astrobel@pamic.org if you need assistance with your credits. Unfortunately, if you don't provide it, then you won't be able to receive credits. So that's not the PAMIC rule. As you know, that's our licensing rules. Of course, we have to mention the antitrust disclosure. At all PAMIC events, we follow the antitrust rules, and we don't have to read those here. Most of us know them almost by heart. And if you had any questions, we have access to the PAMIC staff that can address those if you need. We also want to thank the members of the team at PAMIC, specifically Andrea and Brittany, that have been putting a lot of hours in to pull off these events. So Ron Gallagher's team at PAMIC is just doing an excellent job for these. So now we're at the 10 o'clock mark, a little after, and we can go to our first panel session, our first speaker session. And the topic of this is the property casualty industry in Pennsylvania and the Mid-Atlantic statistics and outlook. I'll be monitoring the Q&A that you can put in the chat. So feel free to ask questions as we go along. And both the speakers today said that they're happy to entertain those as we go through the session. So you don't have to wait to the end or anything like that. So today we're joined with two fine gentlemen, Tony Latini and Bob Farnam of Boenning and Scattergood firm. And I'll do Tony's bio first. Tony Latini has over 30 years of experience providing corporate finance and investment banking services to middle market and large corporate clients. As managing director, Tony focuses on M&A advisory services and capital raising for clients in a variety of industries. Tony has significant experience working with insurance companies, banks, and brokers, as well as companies in other industries. Bob Farnam joined Boenning and Scattergood in October of 2016 as managing director and senior research analyst to initiate coverage of property and casualty insurance equities for the firm. Prior to joining Boenning and Scattergood, Bob was vice president of insurance research at Conning & Company, where he authored research reports and covering covering strategic and financial trends in the P&C industry. Please welcome both Tony and Bob, and I'll turn it over to Tony to begin.
Hey, thank you, Tim. Good morning, and it's an honor to be with you all. Bob and I look forward to sharing some perspective and views on the industry. And in terms of that, what are the perspectives that we bring? Because you heard Tim's introduction, and there's some differences there. I think, many of you know Boenning, full service securities firm based in Pennsylvania here for over 100 years. Full suite of services to the insurance industry, from capital raising to M&A to trading and institutional support, along with Bob's area, which is public company equity research. And Bob's the head of insurance equity research at Boenning. And as you heard in his bio, very distinguished career from Bess and Conning to his wonderful tenure at Boenning. Could not be happier to have Bob helping us on this presentation. I think he's going to be a great resource to everyone here. But to be clear, Bob and I both serve the industry, but from different sides of the house, if you will. Bob is analyzing companies. He's helping investors understand them better. I'm helping companies with the M&A and the capital side. So I just want to make that clear up front. The topic, as Tim was saying, is an industry review of 2020 from a statistical point of view, and then a discussion of key trends that affect the industry, kind of affected it last year, and we expect will continue to provide, opportunities and challenges moving through 2021. As one would probably expect, there's a lot more data on a national and an industry-wide basis, but we've endeavored to include information related specifically to mutual companies, as well as those domiciled in the geographic region represented by PAMIC membership. And overall, the industry is profitable. We've got a positive return on capital, combined ratio under 100, premium volumes generally growing. I just had a chance this morning to look at a draft of our quarterly insurance review that many of you receive. You'll see at least I noted for the Pennsylvania companies covered, probably the best results we've seen in several years on average. But let's not get ahead of the presentation here. What I thought we'd do is just kind of share how Bob and I might break this up. On one hand, we feel it's much more interesting to the attendees and the listeners to have two people sharing perspectives rather than one person just going on for an hour. But it's a little bit more challenging when you're not in the same room together in this virtual environment. So what Bob and I are going to try and do, Bob will take the lead in terms of the kind of the statistics and the trends, and I'll try and chime in where appropriate. And then at the end, just do a little 2-minute update from our September presentation and to the financial management seminar. And, as always, as Tim said, we'll look forward to the Q&A as we move through this presentation. So maybe with that as a place to start, I'll turn it to Bob. Take it away.
Great, Tony. Thanks. So yeah, as you're probably all aware, the statutory numbers came out at the end of February. So we started to take a look at gathering all that data. We don't have group information yet. We just have the individual company data yet, even for the companies that are kind of members of groups. So what we had to do to look at the overall industry is to add everybody together, which has some pitfalls in there, but we'll get into that in a little bit. But I just wanted to let you know that we looked at over 2,600 companies, 400 or so are mutuals, 60 some odd are in the Mid-Atlantic mutuals, and 44 are the Pennsylvania mutuals. So we did break up some of the statistics based on those criterion. So hopefully that gives you some interest to look at. We also took a look at by line information. We looked at premium growth, and we looked at the loss ratio. Combined ratio is not ready for the by line yet, so that's coming a little bit later on with the next filings that come out. But loss ratios are there, so at least you'll have an idea of what performance has been looking like. Just standard material here for our compliance department. And here's just the overview. Like as Tony said, we're just doing the performance review, looking at trends and giving a brief update on M&A. You've seen us. So here we got return on equity. And I think the first thing we noticed on this slide is that returns are pretty modest for the insurance industry. I mean, we're not looking at stellar 10, 15% ROEs. This is a kind of a mid to high single digit ROE industry at this point. Obviously, in the last few years, catastrophe losses have played a part. You've had weaker investment returns because of the low interest rates, and the industry has generated a lot of surplus. So the denominator in that ROE is larger, so that the whole ROE goes down. I will say, since we added all the individual companies, there is some double counting in here in terms of surplus if there are individual insurers that are stacked within a group. However, I think the impact is fairly modest. We're still not looking at double-digit ROE. I think what was interesting here is that mutual companies underperform the PC industry as a whole. It's not really surprising, since mutuals have a different profit objectives than stock companies. But interestingly, Pennsylvania mutuals have fared much better than mutual companies overall. There were, looking at the information, there were 7 Pennsylvania mutual insurers that generated double-digit ROE. Here's a brief list. So we have Goodville, Everett Cash, Windsor Mount, Center County, Conemaugh Valley, Livingston, and West Branch all generated double-digit ROE in 2020.
Hey, Bob, a number of us aren't seeing the slides. Maybe you could try and reshare. That's working.
You know, we practiced this beforehand too. Here we go. So I repeat all that what I just said. So you've got ROE that's again kind of the mid to upper single digits. You've got mutual companies that have underperformed the overall industry, but that's as to be expected. But if the dark gray columns are the Pennsylvania mutual companies, and they've actually had pretty decent ROE relative to the other mutuals in the industry, especially in the last couple of years. So next, we'll move on to the combined ratio. As Tony said, in 2020, we all generated an underwriting profit with a combined ratio below 100. Again, the mutual companies have underperformed the P&C industry overall, although they did break below 100 this past year, which again is good information. I think the interesting thing in this chart is that you can see the overall trend of improvement as you go forward from 2017 to 2020. It definitely seems to be sloping down to the right, which is, you know, I think part of that is related to rates that are starting to increase. There were actually quite a few Pennsylvania mutuals that generated a sub 90 combined ratio. Just to name a few, Everett Cash, Windsor Mount Joy, and Millville all generated combined ratios below 90%. And if you expand out to the rest of the Mid-Atlantic mutuals, Virginia Farm Bureau, Hartford Mutual, and Farmers and Mechanics of West Virginia also generated combined ratios below 90. So a very good year for quite a few of you. And here we have some premium growth metrics. Net written premium. It's been more of a mixed bag over the last several years. There was a big swing in the Pennsylvania mutuals and the Mid-Atlantic mutuals in 19 and 20. That was driven by Pennsylvania Lumberman's Mutual. There was a big drop in 19 and a pickup in 2020. I haven't had enough time to go look through the details and see what was going on there, but that has obviously with only 40 some odd companies, it has a pretty good impact with a large company like that having big swings in profit in performance in terms of premium. The industry premium growth in 2020 was pretty weak. That's obviously negatively impacted by return of premium and auto business based on the lack of driving during the pandemic. You know, the companies volunteered to give back some premium to policyholders, so that had a negative impact on the top line growth, which, you know, we're curious what's going to happen in 2021 when drivers get back on the road, and if things return to normal, we might see a pretty big pickup in terms of you know, year-over-year growth. In terms of net written premium, the top 5 writers in the Pennsylvania Mutual are Penn National, Goodville, Donegal, Pennsylvania Lumbermans, and Mutual Benefit. So those are the top your top Pennsylvania mutuals. Okay, so here we're going to start getting into specific line of business type information. We're going to provide information on 6 of the larger lines of business. That's personal and commercial auto, homeowners, general liability, workers' compensation, and commercial multiple peril. We'll start off with the largest line. This is Pennsylvania. This is personal auto liability. As you can see, it had steadily increased over the last many years, except for 2020, where it fell down again. Again, that's related to the premium returns to policyholders during the year for the decrease in driving activity. California is actually asking for even more money to come back to the policyholders. So they gave a lot back in 2020, and they may be giving back some more in 2021 based on how profitable they were. The compounded annual growth rate here over this time period is a little over 4%. So it's pretty solid growth in the private passenger auto liability. As a percentage of the total business, personal auto is actually underrepresented in the Pennsylvania mutuals. As the industry as a whole, personal auto liability is about 22% of all premium, where in Pennsylvania mutuals, it's only about 10%. So you're not a heavy-duty writer of personal auto liability. The top 3 writers in the state are Penn National, Goodville, and Donegal. You can see the loss ratio that came down as well, 56.5 to end the 2020. Again, a part of that was related to a drop in claims frequency because of the lack of drivers on the road. This is a chart that shows the frequency trend for personal auto liability. As you can see, the pretty significant decline in 2020, down 22% relative to 19. That is obviously a pretty big drop, and I suspect that will go back up. But I think the question people are asking is whether driving will go back to normal, or you're still going to have people working from the house and not driving and not commuting into work. So it's still a question mark as to what the new normal is going to be going forward. But I suspect that the claim frequency trend will start to increase. I decided to put reserve development information on these lines of business just because, you know, the data was there, and I think it's interesting to show. So the personal auto development has been ups and downs, but I think it's been pretty stable the last couple of years, last 3 years. Here in this chart, the negative numbers represent favorable reserve development. So they had a few blips there in 2015 to 2017, but I think that has settled down, and you're getting back to more of a steady state at this point. And the homeowners line of business, this is where the Pennsylvania mutuals have an outsized share relative to the overall industry. The overall industry is about 15% of the premium is homeowners, whereas in Pennsylvania mutuals, it's 21%. So if we would characterize the Pennsylvania mutuals, it's more property and short-tailed property type business that they write relative to the overall industry. Written premium has steadily increased here. The compound annual growth rate here is 4.6%. So again, pretty good growth rate there. There's been some volatility in the loss ratio, but again, that comes with the line. That's largely catastrophe type information. So that's, as you can see, the little blip up in 2020, you had a large number of events in 2020, not significant in terms of size, but a lot more frequency, probably a record number of named storm losses this past year. So the overall industry generated an 68.6, but the Pennsylvania Mutuals did much better. They had a loss ratio of 61.8. So a good 7 points better than the overall industry in terms of the homeowners performance. And the top 3 writers of homeowners in the state are Goodville, Penn National, and Lidditz. Anything you want to jump in with, Tony? You're good.
I did what they advised us and turned the function to mute. Of course, that requires you to unmute before you talk. Yeah, no, I think a couple of comments, and I think for our group, you know, Bob's comments are very data driven and reflect his insights from around the country. My comments, I think these are probably more what some people would call anecdotal. It's my clients and friends, rather than anything purely statistical as this report is. But, you know, a number of my clients are commodity lines, but many of them are more specialty. And I think you'd expect to see maybe a difference between those two groups. But what I have found very interesting this year has been, with the exception of those maybe specialty writers that are focused on something that was really adversely impacted by the lockdowns, I haven't heard anyone, commodity type product versus really specialty, that haven't really felt pretty good about premium growth, very consistent with what Bob showed. But I think also in terms of, you know, the auto writers that we just went through, you know, pretty strong period. You know, the homeowners companies, I think it's varied in terms of losses, as Bob's indicating. A lot of named storms. If you were in a part of the country where that was really impacting you, boy, you know, it was a tough line. But a lot of my clients, particularly in the Pennsylvania and Mid-Atlantic area, done, you know, fairly well and pretty consistent with what you heard. But you know, overall pretty positive. Thanks, Bob.
Yeah, no, I agree. I think the fact that obviously the Pennsylvania guys have more of a challenge with the winter storms and whatnot, so you're not really big in the heart of hurricane territory, but that's probably a benefit to writing where you do. It's a nice space to be in terms of cat losses.
Bob, Tim here. Question about expenses. Is that a slide you'll be getting to? You talked about the combined loss ratio. I just wondered if you saw any you know, decrease in expenses because of, you know, efficiencies, or the mutuals running, you know, equal to the other industry. I just wanted to get your comments on expenses.
Yeah, that's the thing that's not available yet. So we can't get the expense ratios by line right now. That comes with the IEEs when they're filed at the end of March. So we don't have that information by line. That's why I've basically had to show the loss ratios only.
Okay, that's okay.
It'd be nice to be able to show the whole combined ratios, but I can't give you the insights on what's happening with the expense ratio at this point.
Okay, thank you.
And, you know, Tim, I think my perspective, one of the things that I think we're continuing to hear, particularly from the smaller and maybe even the mid-sized carriers, is that, you know, costs keep going up, right? You know, the accounting, the compliance, the regulatory, all the stuff that this audience knows all too well. A little harder for the small companies and the mid-sized companies to absorb them the way maybe the larger carriers can. So, you know, that expense side is still, you know, still a bit of a problem.
Anecdotally, I'd say that the mutual companies tend to have higher expense ratios than the overall industry, just because what I'm looking at the data here, their loss ratios seem to be outperforming the industry. But as I showed you in the beginning, the combined ratios are a bit worse than the industry. So you kind of subtract the two and you think, all right, the expense ratios are a bit higher for the mutual companies, but I can't tell you how that's trending in the recent years and in 2020. So,
Okay.
I put the chart here for reserve development. Reserve development is really not a big deal for a short-tailed line like homeowners, but again, that had been deteriorating, but it had a pretty good rebound in 2020 with almost $1 billion of favorable reserve development. General liability, as you can see here, the premium growth really took off in 18, 19, and 20, and I think a lot of that was related to the improvement in the rates. I think with people complaining about social inflation and other claim severity issues, people have recognized that there's an issue in general liability, especially for the longer tail types of business where you may have years before you pay claims. So anything that's happening now is gonna compound over time. So companies have been really putting more effort into getting rate in this line of business. Even then, you see the loss ratio still picking up over the past few years. So the rate that they're getting, it's still hard, they're hard pressed to keep ahead of the loss trends. And this is the reserve development for the line. As you can see, this is really deteriorated in the last several years. Again, the performance of the line, this is basically indicative of the claim severity trend. It's getting a lot worse than companies had originally expected. So they're having to boost reserves to kind of compensate. Okay, so here we've got workers' compensation. This has been the outlier. I started working at AM Best back in the late 90s, and I was the lead workers' comp analyst back in that time, and that was a terrible time to be a workers' comp writer. That was like the worst line in the industry. But the last decade or so, it's been the most profitable line. I think just the claims frequency trend has continued to decline, and the claims severity trend has been benign. I think that basically the losses that management teams expected to materialize did not. So that has resulted in quite a bit of favorable reserve development and pretty strong results. Because of that, this is the one line where you're still having rate declines. It's been so profitable that the competition is still pretty intense in this market, trying to get a piece of this puzzle. Here's the reserve development of workers' comp, and you can see it's been pretty substantial over the last decade or so. Again, this is a far cry from what I was used to when I was at AM Best in the late 90s, early 2000s. That's when other workers' comp companies started to take reserve charges, and quite a few went under. But different story now. Let's see. This is the commercial multi-peril. Very similar to homeowners. You got a lot of property exposure in here, so it's the loss ratios a bit volatile because of the catastrophe events. But here you have the strong premium growth as well. I think some of the premium growth here is similar to what you see in the general liability part. The commercial multi-peril on the casualty side has seen the same trends that you've seen in overall just general liability. So I think a lot of that is reflecting the rate increases that have been coming through in CMP. It's been more of a mixed bag in terms of reserve development for commercial multi-peril. You can see the last few years have been kind of up and down, but again, there's a pretty good portion of shorter tailed property business in here, so it's not as big of a deal as maybe some of the pure casualty lines. And last but not least, we'll come to commercial auto. This has been the industry's troubled child of late. You can see the loss ratio trend had been consistently going up got the drop in 2020, but again, that's related to the drop in claims frequency. Just like personal autos were not on the roads, a lot of commercial vehicles were not on the roads either. So the claims frequency declined. And you see the pretty significant increase in premium related to the loss, the rate increases that have been going through to try to mask the try to catch up with the loss trend in this line. So as you can see here, this is the frequency trend in commercial auto liability. It's the same as personal auto liability, a pretty big drop in claims frequency. Again, that will likely rebound as the economy opens, but certainly the companies enjoyed the improvement in 2020. And reserve development for the line just has not been good. It's something that all these companies have to deal with, trying to keep up with the claim severity trend. Again, social inflation is a part in this. So it's remains to be seen how far the rates have to go up to be able to actually normalize profitability here. So I just decided to put in here are all lines combined. Here's what the trends have looked like. Again, you see a decent drop in the loss ratio in 2020 because of the auto business. And reserve development for the overall industry has been doing very well. In terms of points for development, you're looking at a point or so of favorable development in the past couple of years. And that's continuing a trend that's been going on for quite some time. I also wanted to put in here, this is what the reserve development looks like when you take out workers' compensation. So workers' compensation has been the big driver of favorable development. But when you take out workers' comp, this is what the other lines look like. You can see there, it's more probably you're getting around break even at this point in terms of favorable reserve adequacy. So we're going to start getting into trends now. Tony, you want to anything to add at this point, or you want me to just start getting into trends?
Why don't we move on to trends?
Okay. So I think as Tony and we talked to companies, I think that for the most part, companies expect improved numbers in 2021. Rates are going up in almost all lines. Most of the management teams that I speak to are talking about rates that are in excess of the loss trends, so they see improved margins coming forward. I think with the vaccines rolling out, you're going to have some consumer optimism, and that will start to, the economy will start to grow, which is going to certainly help in terms of the top line for the industry. Lines like workers' compensation that have had some pressure because of the decline in payroll that may come back in 2021. So the workers' comp companies might see a better boost to the top line, but the same goes for most lines that are related to sales volumes and things like that. So I think all the companies that are out here are looking forward to 2021 and having some sort of rebound with the industry. I think the question is, what's going to be the new normal? I think we're all talking about, so are we all going to be going back to the office? Are we going to have a hybrid working from home, working from the office? You're going to have a lot of turnover in businesses because of the COVID. Are they still around? So I think the question is, what is the new normal going to look like going forward? But for the right now, I think there's pretty good optimism for the industry that things will bode well in 2021. I think you're going to have, when you're looking at year-over-year comparisons, obviously you're going to have the change in frequency for the auto lines coming back in 2021. So your year-over-year is going to look worse. But again, 2020 had a pretty significant amount of catastrophe losses. So if 2021 normalizes, I think you're probably net looking at an improvement in 2021 relative to 2020. That's the guess right now.
And Bob, we had a question that came in, if I can interrupt.
Yep.
It said, your comment regarding rising rates does not seem consistent with personal auto market trends. Can you comment on what you are hearing there? And again, it may be some of what you were just getting into there.
Yeah, no, I'm talking overall rates. Certainly in commercial auto trends, I think that there's been a lot of pressure on the commercial auto, personal and commercial auto writers to since they were so profitable in 2020 that the regulators are asking them, hey, you might want to lower your rates now to kind of be kinder to the policyholders. So yeah, when I'm trying to paint everybody with a brush here, but there's certainly lines that are having some pressure. Workers' comp is still down. Personal auto is probably going to be under some pressure in the near term just because of the improvement that they've had in performance. Commercial auto, despite the fact that they had a pretty good year, I still think that the severity trends there are going up. So you're going to still have pressure to raise the rates there. But I think in the near term, you're probably going to have some personal auto rate improvement before it starts to normalize again.
And, I think Bob and I were talking as we were putting these materials together, and, there's almost a lack of comfort when you see some fairly positive news for the industry, because we've all, I think most of the folks in this virtual room have been around long enough to know that good news seems to go away from this industry way too fast. I mean, I think on the positive side, when you have an interest rate environment that the Fed is basically saying zero for a while, it means we need to focus on underwriting profitability. That seems to support rate. And, I mean, there are a lot of, management teams that are paid based on underwriting profitability. So that all seems to say to us, boy, this could be a good year. However, we all know the history, and there tends to be a lack of discipline in the industry. So maybe I'll stop with that. But it's an exciting beginning to a year. We'll see how it ultimately turns out.
Yeah, I think it's like the soft markets will last like a decade, but hard markets might last a year or two or something like that. So they're short-lived, but enjoy it while it's here. So this with the expectations of improvements in 2021, especially in specialty lines. I mean, you're talking about, typical commercial, standard commercial lines are getting mid to high single-digit rate increases, but you're looking at specialty commercial lines that might be 20% or north of 20%. So you're having a lot of companies that are looking to get into that market. You've had a lot of new capital coming in. Companies trying to add excess and surplus lines type operations to be able to capitalize on that business. You've got a series of IPOs and special purpose acquisition companies out there, SPACs. Tony may get into that with his M&A topics, but there's been a lot of capital coming into the industry to try to capitalize on the opportunity that's out there. In terms of the social inflation, again, that's not a new thing, but that seems to be what's been in the industry, people talking about. But you're talking about the legal environment, nuclear verdicts, large jury verdicts. You're looking at companies, juries looking at insurance companies as deep pockets. You're looking at the expansion of what coverage terms are in favor of policyholders. So again, that's not a new thing, but that seems to be something that all these management teams that I talk to are still worried about. And again, that's one of the reasons why the rates are going up in 2021 is you still have a lot of these drivers there. You've still got, you've had elevated catastrophe losses, you've got social inflation, you've got, still questions on COVID losses. Will there still be some COVID impact in 2021? So there are reasons the rates are going up. It's just a matter of whether or not the losses are going to go up as much as well.
And Bob, on the COVID comment, we just had one that came in. General question about, are either of you seeing any return to offices out there for the insurance companies that you've been talking with?
Tony?
I think this is kind of a humorous topic because over the last few decades, so many insurance companies, I think, were looked at as very, very traditional. And so many of my friends would tell me that, well, there's no way I'm going to let my employees work at home or anything like that. And I actually believe in talking to companies within the industry as well as outside the industry. I think the insurance industry, I'm going to say this broadly, has done a better job with the work from home. And I don't hear too many CEOs saying we're just dying to get everybody back. I think what we have seen, that's over the last year, what we have seen the last 30 to 45 days is a little bit more acknowledgement of maybe from an employee morale, a culture, maybe management of certain employees. It might be better to get them back in the office. I've been hearing that a little bit the last 30 days or so. But overall, during the course of this last year, it's been remarkable to hear how well the industry has functioned. I don't know, that's my view.
I have not seen any wholesale return to the office yet. I talk to management teams, but frequently the manager, the executives that I'm talking to are the only ones there in the office. And, you know, there's a few and far between, but I have not heard anybody saying we're open up again. And again, I think that most companies are trying to figure out is there a good balance here? Is there a balance of working at home versus coming to the office? I know even at Boenning, you know, we've had you know, expectations to come back into the office that keep getting pushed off because obviously things are taking a lot longer than people expect. But I'm curious, even for Boenning's perspective, what are we going to look like going forward? So I think we're kind of all in the same boat here as to what that new normal is going to be.
Yep. Okay.
Bob,
Yeah.
Jim, this is Ron. On Thursday afternoon, the last session is actually covering issues that companies will likely have to deal with or thinking about in terms of the new work environment post-COVID time. And it includes a presentation, about an hour and a half presentation by a legal counsel as well as an HR director for one of our members. And then it's followed up by a panel of three senior people, two insurance company executives, David Gauci at Goodville, Dan DeArmond at Friends Cove, and the other, off the top of my head, it's a sign of gray hair, I guess, is one of the managing partners at Brightcore, which is a totally digital company. They never had offices. They started out as a digital company, so they have a different perspective to offer. So if you haven't signed up for that, the audience, you can view that on Thursday afternoon. Thank you.
There you go.
Thanks, Ron. I think we pulled Bob off. You're at social inflation moving towards reserve adequacy. Sorry about that, Bob.
Yeah, so reserve adequacy, like I said, the charts. I mean, you've had several years now of pretty favorable reserve development, and I think that people are concerned about going forward if social inflation takes a hold, if regular inflation takes hold, if you know, the pricing is not keeping with loss trends, if whether or not that benefit from the favorable development is going to stick around for much longer. But I suspect that development from here is probably going to not be as strong as before, but I suspect it'll remain favorable, at least for the near term horizon. And focus on core business. Now, I've had a lot of companies that I talk to that, you know, they're looking to strengthen their underwriting operations. Like Tony said, you know, the investment income's not there, so people are going to have to focus on their underwriting. That's not new. That's been something that's been going on for quite a few years now. But you seem to have had a lot of movement this past year with companies divesting non-core businesses. You've had P&C insurance companies selling their life pieces and life companies selling their P&C pieces. You've had you know, companies that are just getting out of territories that maybe are not as profitable. So you've got a lot of focus now on focusing on what companies do best and kind of ignoring the rest. And that's obviously, you can do that when in a hardening market, because you're not as worried about top line growth and profitability and whatnot. I think in a soft market, you may be more pressed to write stuff that may be questionable, but in a hard market, you can really be picky and choosy. And I think these companies are being picky and choosy these days, and really kind of culling their business to focus on generating better returns.
Yeah, amen. I think that not talking out of school here, but we've spent more than an average amount of time in the last, say, 6 to 9 months with some of our clients and friends, evaluating what's core, what's most profitable, what doesn't belong. Now, actions on that may take longer than just evaluating it, but I think anecdotally, I'm seeing what Bob is very much made a good case for.
Innovation. I think one of the side benefits of the pandemic is the fact that it really forced companies to enhance their digital capabilities in a quick time frame rather than maybe a 3-year plan. They had to do it within a couple months. So I think companies have been pretty successful in that regard. Like Tony says, most of the companies that I talked to felt pretty good about how they dealt with the pandemic in terms of their digital capabilities and their employees working from home. It seems to have worked well. But now you've got companies that they've got to keep up now. They've got customers now that have been at home and they're looking for a different experience. So there's been a lot of insurtech influx into the market. You've got insurtech companies partnering with insurance companies or just being purchased by insurance companies. So innovation seems to be the name of the game in 2021 and as we go forward.
And it's interesting that we've seen this so much in the personal line side of the house, but now you're starting to hear much more about it on the commercial lines. Particularly those companies that are dealing with maybe small commercial businesses, they've been largely immune to a lot of these demands, but I think you're really seeing demand from those small businesses to make things as easy as possible for them to transact business as quickly and as simply and on their own time and efficiency schedules. So this isn't going away, certainly, that's for sure.
Yeah, I think when I'm talking with Tony about this, we're talking about the small business owner, that the owner works on the business and may have only a few employees, doesn't have a whole lot of time to devote to looking at insurance coverages. So they want something quick and easy, and they want to be able to do it when they have time to do it, which is probably not in the middle of the day when an agent's around. They might want to be doing this at midnight when they're sitting in their bed with a laptop saying, all right, now I can actually focus on doing this. So they need a lot more flexibility in terms of what the industry is offering them. And that's driving a lot of this innovation. I'm expecting part of your panel is coming up. We'll talk about cyber risks growing. I think that's one of the issues with everybody working from home. We've had an increase in cyber attacks. You've got ransomware. Things are coming out these days. The rapid adoption of new technologies seems to be ripe for issues with hacking. I've heard things like autonomous vehicles are vulnerable to hacking. So this is definitely a product that the insurance companies are going to have to deal with. You're going to have to deal with the silent cyber until they figure out how to specify the policy language and just traditional straight up cyber. This seems to be a growing field of risk that the insurance companies have to be wary of. I think if you're looking at the top risks in the industry these days, the top 3 were business interruption and pandemic and cyber. So this is definitely one of these up and coming risks that need to be dealt with. Like the pandemic, it may not be easy. You're talking about, what happens if you've got a cyber event that knocks out power to an area. Are the insurance companies going to be liable for business interruption? Can they handle that much? I think the same thing with the pandemic is, the insurance industry is not really designed to handle that much risk. Both pandemic and cyber almost seem like they're ripe for products like parametric coverages, which is basically, if a certain parameter is met, then the policies will pay. It doesn't necessarily have to be, you have to prove a loss, but if something, if an event of a certain size happens or a certain location happens, policies pay. So that might be something that you've got some product innovation that might be out there that will have to be there to tackle these types of issues. Lingering pandemic issues. I think the industry has said there's a lot of concern about unrecognized losses so far. I think that the industry has recognized a large portion of losses, but I think the initial expectations were there was a lot more out there. So it remains to be seen whether or not that's still going to be something that that comes around. You still have business interruption lawsuits that, for the most part, insurance companies have been successful, but there are some that have gone to court. You've got the UK Supreme Court that finally agreed with the fact that the insurance companies have to cover this stuff. So it's not a slam dunk that the business interruption issue is going away. There are still events being canceled. So the fact that if you didn't address your policy language and your event cancellation, your contingency policies, you may still be liable for event cancellations. So that's still around there. And you've got things like the workers' compensation presumption of coverage in many states that could lead to more claims for workers' comp. You've got potential issues in directors and officers liability and employee errors and omissions coverage, medical malpractice. The issues are there. They're not necessarily going away. How many doctors may be sued because they delayed, people delayed getting their non-essential surgeries or whatnot, and they had complications. So pandemic is still around, and it's still maybe an issue for the industry to deal with. Legal costs, even, the companies, even if they're successful defending themselves against the business interruption losses, they have to pay the legal fees to be able to do it. So again, it's not going away in the near term. Increased risk of inflation. That's something that we've all probably read around in the papers these days. People worried about inflation picking up as the economy returns. I think really with inflation, the insurance companies feel it in a couple areas. You feel it in the pricing. If you're pricing a product now, expecting a certain number of losses and time frame for losses, you're going to have to raise your rates. It's going to impact reserves. You're going to have to basically increase the reserves to be able to take into this higher inflation. And it's going to reduce your asset valuations just because of the bond portfolios as the interest rates. If interest rates go up, then the bond values will come down. So it's more of a concern for the longer tailed writers than short tailed, but it's something that's definitely out there. I don't necessarily know that we're expecting a big increase in inflation, but that's what the concern is. And it's more of a concern for the longer tailed companies. The shifting consumer behavior and expectations. This is, you're getting more demand for the online options. Again, I think we kind of touched on this. You're going to have greater emphasis on customer experience. I think what the insurance companies will need to do going forward is I think it'd be good if they have clearer policy language. I think just for the arguing back and forth over business interruption is just not a good thing for the industry. I think it behoove everybody to have a better, clear policy definition as to what's covered and what's not. So you're not going to get into these arguments. I'm not sure if that's an easy task. I know everybody uses the ISO forms and whatnot, but certainly it seems like policy language is ripe for modernization. The customer-centric non-insurance intrusion into the space is an interesting one. I think it's basically related to companies that have a good customer base getting into the insurance business. So you're talking about things like Tesla getting into the auto insurance business. They can just ask the customers as they're buying the car whether they want to get into it, and they think that they can generate one of the largest insurance companies out there if they just follow that. You're talking about General Motors partnering with people to do something similar to autos. You're talking about Amazon starting to write insurance in India. These companies have a big brand and a lot of customers, And now all they need to have is an insurance product to offer them. So you've obviously had some insurtechs that have gone down this road, some more consumer friendly insurtechs. That Lemonade, for example, has had a pretty good success in getting customers in. Now it's a question of whether or not they can get the insurance end correctly, because they're, specifically for Lemonade, they still have yet to make money. It's just they've got the customers now. Can they work the insurance angle better? And lastly is the climate change. Obviously, you've seen an upsurge in number of events, severity of events. You've got rising sea levels potentially that could wreak havoc with flood losses. You've got increase in secondary losses like wildfires, hail, tornadoes. So it's, again, this is kind of going back to the new normal. Is this what we're going to be dealing with now? This type of climate. You've had this past decade, you've had pretty good amount of record storm losses for the industry to cover. So is that something to go forward? I know in Pennsylvania, for the Pennsylvania mutuals, may not be as much of an issue, but certainly for the overall industry, it could be something that is cause for concern, that they have to change their models.
Bob, on these trends that you're outlining for everyone, if you were a mutual in Pennsylvania or Mid-Atlantic, which of them would give you nightmares as you're trying to sleep? Any preference? I mean, they certainly are all concerned. When I hear about risk of inflation, I feel like it's the people crying wolf a little too often. I think we're going into decades where they keep saying that's coming, right?
Yeah.
This time might be the real deal. Climate change, like you said, may not be necessarily Pennsylvania or Mid-Atlantic issue, though we'll have other topics in this seminar on weather and things like that they're impacting. But what would keep you up of all the ones that you're trending? What would be the one or two that they should keep an eye on?
I think Tony and I have had a brief conversation about this stuff, but I think the changing customer behavior is one to keep an eye on. Obviously, you've had the Geicos and the Progressives of the world kind of taking over the commoditized personal auto product. Where you get the customers getting into the homeowners product, which is again is a pretty good mainstay for Pennsylvania mutual companies. I've had companies that have said, we're not going to compete with Geico. We're not going to successfully compete with Geico and Progressive. We need to focus on specific areas of customers that will utilize independent agents. We'll be fine with a mutual company structure. So it's a matter of maybe tweaking your typical customer to make sure that you're targeting the right people that value what you're offering. I've had companies that said, we're not going to be just doing standard homeowners business anymore. We're going to go upscale. We're going to go more to the next level up in terms of wealth. We're going to go higher valued houses. 1 million or 2 million or 3 million, because that's where the customer is going to favor more service, more expertise. Whereas your standard insurance policyholder, again, it's probably more price driven. So I think the personal lines business is where you're seeing a lot of that, obviously. But I think you can start seeing some of that in the small commercial as well. Whereas, your customers may be looking for something else, and pricing may become more important rather than services that you offer or expertise that you bring to the table. So the customer behavior was one that I'm particularly interested in seeing how that plays out. Tony, anything?
I can't agree more. Everything you just said on the customer side, I think is the biggest challenge that a lot of our company clients face. And it's not imminent today, but it's imminent over the next 5-year period of time.
Yeah, I mean, even things in homeowners like with Lemonade coming in and kind of trying to tackle the young policyholder buying their first insurance. Their whole plan is to kind of grow with that policyholder as they buy a house, provide homeowners insurance. As they get a pet, provide pet insurance. As they have children, have life insurance. So it's they're trying to capture these customers way at the beginning. So I think the standard homeowners writers have to keep in mind that their customer base may be changing, and they may have to tweak what they're targeting.
Yeah, Bob, I think you're talking about the customer centric. I think it's a very important topic. I'm glad you brought up Lemonade and the fact that they have the people and now they want to figure out how to make a dollar.
Yeah.
And they did renters insurance, and they were surprised New York, for example, was interested that they had the proper paperwork. It's shocking to all of us. Where the insurance industry, we're trying to figure out how to go through the product and licensing, and then we talk about our customers, right? It's totally
Yep.
reverse. You see it on TV that you have a Hippo, you have Roost, all of them are advertising. I don't know if they made money yet or not. Some of them, of course, are doing the IPOs. So I think it was Google or Amazon that tried to get in the insurance industry, might be Google, and they said we were so bad on the ROE, they gave up. So it'd be fascinating if Amazon, I think it was Google that did that. So it'd be fascinating that Amazon's in India, whether they, reach the same conclusion. So to me, that model is fascinating because I have a group of people now. What can we sell them? Which is a bit
absolutely. It's starting with the customer base, and that's it's only a matter of time before they figure out how to make it work in terms of the underwriting side. So that's evolving. Obviously, these insurtechs that have started up have not really made money yet, but if they can hang around long enough, they'll figure it out.
Okay, I think we're down to our last minute or so. Do you both have a concluding remark?
Tony, you want to?
Yeah. Why don't I try to wrap it up? PAMIC has arranged for a separate session on affiliations and strategic combinations, and I don't want to detract from any of that. But just as we mentioned at the beginning, a number of the trends and topics that Bob mentioned flow into M&A. And back in September at the Financial Management Seminar, we're kind of looking at M&A as to what's going to happen in this pandemic year. And I thought just a quick wrap up, and we'll leave the slides with you with the data. But as we mentioned there, M&A was still at a healthy clip for the M&A for the P&C side of the house through September, and we saw the year finalize in exactly that way. No real expected reduction as people had thought during the pandemic. On the agent and broker side, we did see a decline during the summer months in the earlier stages of the pandemic, but boy, did that rebound. We're still averaging over 2 deals per business day. And that's important for our industry because those that are dependent on independent agencies, as those small agencies start to get gobbled up and become part of something larger, sometimes that affects some of the smaller carriers out there that we care so much about. So, that's still an important thing to watch. And I think just overall, the general optimism from the industry, the clarity on financial results and the decent financial results and the large amounts of capital that are still available means we're going to continue to see activity in both the agent broker space as well as the carrier space. But I don't think I want to touch on any more than that. I want to try and keep us on schedule, Tim.
Perfect.
I really appreciate the opportunity to be here.
Lost track of time.
Yeah, well, thanks, Tony and Bob, for an enlightening session. And if others have questions, we can certainly route those to you later. And at this time, we'll take our break to 11:15. And so we'll see everyone resume at 11:15 and have a good 15-minute break. Again, thanks to Tony and Bob. We appreciate your speaking today.
Yep. Thanks for having us.
Thank you.
Bye.
What's the best way to protect your business? With Donegal Insurance Group. You've poured your energy, your passion, and your heart into this business, and you want it to succeed for generations to come. That's why our agents partner with you to ensure and protect what you've worked so hard to create. Protect your business. Protect your future. Visit DonegalGroup.com/protect to connect with an agent today.
Running a business is more challenging than it has ever been. We know staying competitive and driving your business goals are your top priority. But the cost of compliance is going up, while internal time and resources are going down, all while the cost of an hourly attorney and consulting fees continue to rise. And with those rising fees, you still have limited accessibility and less than ideal response time. So where do you go for answers so you can quickly get back to achieving your business goals? Enquiron is here to provide you with an on-demand, accessible, and easy-to-use solution that you can begin using immediately. It takes just 1 minute to register. Get unlimited support from our client services team. Save an average of $12,000 annually. Oh, and stay in compliance. Sound too good to be true? Well, it isn't. You get unlimited access. Get started today. And suddenly, the path toward compliance isn't so challenging. In less than 1 minute, you can log in or register and be on your way. Stay focused, stay competitive, and drive your organization's business goals. Let Enquiron help with the rest. Our client services team is standing by to answer any questions you may have. Turn your questions into answers.
Electrical failure is a big source of fire, personal injury, equipment damage, and lost business. In fact, fires in commercial buildings cause billions of dollars in damages and injure more than 1,000 people each year. What if I gave you the power to look inside your book and detect electrical failure hazards before they cause serious loss? Loss of property, income, even lives. Would you be interested? Of course you would. But how, you ask? While electrical failures cannot be totally eliminated, they can be significantly reduced by applying an electrical risk management strategy, one that leverages engineering knowledge, data, and analytics to help your customers keep electrical equipment and systems operating efficiently and safely. HSB's Electrical Risk Management Program brings technology-driven solutions to pinpoint hotspots so equipment owners can get equipment repaired before it fails. Advanced data and analytics allow us to evaluate conditions and make recommendations to mitigate potential losses. And because we understand each risk has a unique set of conditions and each electrical system has unique characteristics, we apply a consultative, client-centric approach to understanding your customer's operations. Working together, we can design an electrical risk management solution to meet your underwriting and risk assessment needs while helping your customers improve their electrical failure prevention efforts. For more information about electrical risk management, contact your HSB representative.
Well, Loudon Mutual's been very blessed with a lot of growth. We started out as the mutual fire insurance company of Loudoun County. We wrote policies in Loudoun County. And over the last 10 years, we've gone on a large growth spurt. Our operation has become much more complex. And also the regulatory environment has gotten more complex. Our previous firm was a local firm. They're great folks and they're very good at understanding small businesses, but they didn't have an insurance background. They didn't understand the specific nature of statutory accounting. And what we were attracted to Brown Schultz was they brought a strong insurance background. Not only did they understand the insurance accounting, statutory accounting, they also understood small to mid-sized firms like us.
I was new to the insurance industry, and Brown Schultz was very helpful in helping me with that transition to make sure that I understood all of the insurance-specific reporting required under statutory basis.
Well, just as Loudon Mutual is, we are neighbors helping our neighbors, Brown Schultz is very much involved in the mutual insurance community, and they're there to help companies like Loudon Mutual succeed.
Even though geographically we're not located down the street from Brown Schultz, I've never had any issues being able to connect with them. They're very responsive.
I think one of the unique things about Brown Schultz is the fact that their senior people have such deep experience. Generally, you only find that kind of experience and that kind of expertise with the very, very large firms. But they're small enough that we can work with them, they're personable, we can get in contact with the principals, and they're just a really good partner for us.
I've been most impressed with Brown Schultz with the people. They care a lot about what they're doing as well as about their clients.
I would say Brown Schultz is the right fit and the right balance for companies like Loudon Mutual. We get the large firm experience with having the small firm touch.
New England Asset Management, NEAM, was built to serve the unique needs of insurance companies.
We've just focused on building out our people, our technology, nurturing our culture, developing our product and our capabilities.
We create highly customized solutions for each of our individual insurance clients.
We think there are universal aspects to being from New England that translate whether you're in Bermuda, London, Europe, or the US.
I think about wholesomeness, I think about hardworking people.
We want to be known as that partner that's easy to do business with, that understands them, and it's someone that they can trust.
We want to be thought of as your thought partner, part of your success, your investment department down the hall. We remain true to our roots here, we remain true to our insurance focus, our dedication to purposeful partnerships.
And that continues to be our focus today.
We are New England Asset Management.
We'll be starting in a few minutes. Okay, welcome back. We'll be starting in about 1 minute. Okay, looks like it's about that time. We'll be starting our next session, which is titled Corporate Transactions in the Mutual World. We're very lucky today with our featured speaker, Jeff Waldron. Many of us known him for a long time. Very happy to see him. Hopefully in person soon for a lot of us, as we hopefully are transitioning away from virtual, but time will tell, as we all know. I'll give you some background on Jeff. Jeff Waldron helped launch Griffin Financial Institutions Group in 1999. Now, more than a decade later, he's leading a group within the bank focused solely on insurance. A specialist in the niche mutual to stock conversion field, Jeff has advised on more than $10 billion in transactions and played a role in establishing demutualization legislation in Pennsylvania and Delaware. Please welcome Jeff. And Jeff, the floor is yours.
Thank you, Tim. Good to see you. I appreciate the opportunity to speak. I'm going to cover a couple topics, primarily affiliation transactions and mutual holding company formations and reasons why you might do either or both. So, feel free to email questions as they come up, but I'll start with sort of a discussion about affiliation transactions. When I first started doing this, before I started...
Jeff, just sorry to interrupt you. One question, could you make your screen full, please? Is that possible?
I thought I had it full.
Okay.
Let me see whether I can move it around a little. Oh, that's smaller still.
Hey, Jeff, this is Ron.
Yep.
At the bottom of your screen, there on the right-hand side, there should be a couple of icons there. If you lift your screen up just a little more, I may be able to see it. Yeah, use the that bar. Okay. Hey, Britt, can you help him out here?
There we go.
There you go.
All right. Sorry about that. So, I wanted to talk about affiliations initially. Before I joined the investment bank, I spent 20 years being a corporate and securities lawyer, and I had never heard the term affiliation until I started doing more with insurance companies and mutual insurance companies in particular. It's actually a term of art that is unique to mutual insurance companies. And it actually engenders a fair amount of confusion, even in the mutual industry. Sometimes you talk to people and they say, well, what exactly is an affiliation? And let's start with what it isn't. There's no merger. There's no sale of assets, a renewal rights transaction, or a lost portfolio transfer. All it really is a contractual relationship between two parties. So typical affiliation contains at least one, and sometimes as many as 3 documents, but they're really just 3 contracts. The first one is a management agreement in which and I'll use the term buyer and seller here because that's easy, but it's kind of a misnomer in an affiliation transaction. But in the typical affiliation transaction, the core document is a management agreement where the buyer enters into an agreement to manage the seller and inevitably takes control of the board of directors of the seller and effectively, therefore, has acquired control under the Insurance Company, Holding Company Act. The existing directors either all resign or they're reduced to a number such that the seller's nominees are now the majority. So that's the core document, and that's always present in any affiliation transaction. The other two agreements, which are sometimes present but not always, is a reinsurance agreement in which the typically what happens is the buyer cedes premium to the seller, either in part to provide capital support or in whole pursuant to some sort of pooling arrangement. And the third reason, the document that sometimes happens is a surplus note investment by the buyer into the seller. And we'll talk a little bit more about why that might happen in a minute or two. Concurrently with this, there is also a regulatory application because I said the buyer is taking control of the seller. So there is almost always a Form A that needs to be filed with the insurance department seeking control. But that's really what an affiliation is. It's a contractual relationship, no assets change hands other than prospectively pursuant to any ceding or pooling arrangement. So why do affiliations happen? Well, historically, they have happened between a stronger, larger company and a smaller company that is sometimes distressed, sometimes a little too small to remain viable in the long term. Sometimes a smaller company that may have a succession issue. Obviously, since it is a transaction between two mutuals, there is little or no financial consideration paid. Sometimes there is some retention agreements paid to management of the seller. Sometimes there's board fees paid to the departing directors. But for the most part, there is no financial consideration. And that actually is a problem in some sense in that it makes affiliation transactions very difficult to do because absent some sort of exigent circumstance, there's very little impetus for someone to do, for someone to be a seller in the affiliation transaction. And affiliation transactions, therefore, all boil down to negotiating the social issues. And by that, I mean things like, well, okay, who's going to be the CEO of the affiliated group? Who's on the board? Things like that. And those inevitably are difficult to resolve. I'll sound like the cynical investment banker for a second, and sort of a rule of thumb is affiliation transactions generally kind of violate the good deal rule, which goes something like this: if there's enough money in the transaction, every problem is solvable, and if there's no money in the transaction, every problem becomes insuperable. And that's why affiliation transactions rarely happen between two very healthy companies, and certainly healthy companies of the same size. Now, a few years ago, we thought, well, gee, maybe something's changing, because if you remember, in 2017, there were a series of transactions, and they happened very close together in time. And that was Donegal acquiring Mountain States out in New Mexico, Motorists from Columbus, Ohio, doing an affiliation agreement with Brick Street, and auto owners out of Michigan doing an affiliation transaction with Concord. What was remarkable about those three transactions, separate and apart from the fact that they happened almost all at once, was that none of the nominal sellers in the transaction, Mountain States, Brick Street, or Concord, were distressed. And in fact, they were all fairly large companies. And so there was a lot of speculation back in 2017 that maybe the world has changed. Maybe some mutuals see the virtue in consolidating and gaining scale and capabilities, et cetera. Motorists is a classic example of that. Motorists had a wide portfolio of different companies and wrote commercial and personal lines, but didn't have a lot of comp. And Brick Street was a monoline comp company, and they were very complementary. And that transactions worked out fairly well. And so the speculation was, well, maybe people are seeing the virtue of affiliation transactions. In general, that has not proven to be the case. There has not been a lot of folks doing affiliation transactions. The most recent one we were involved in, was Loudon Mutual's affiliation with Community Insurance in Pennsylvania, and I'll talk a little bit more about that on the next slide. Community had formed a mutual holding company back in 2019, and that was specifically to facilitate the combination of Clearfield Mutual and Lehigh County Mutual into one organization. And that was, as I said, completed in 2019. They also did an affiliation transaction in which they took control of the board of Montour Mutual. So after those transactions occurred, you had a mutual holding company that controlled a new insurance company that resulted from the merger of Clearfield and Lehigh County called Community. And they also had an affiliation agreement with Montour. But even with that aggregation of those three companies, still a pretty small company. And Community decided that it wanted to do an affiliation transaction, in part to achieve more scale, in part to achieve more capital support that Loudon could provide, and in part, I think, to probably address some, long-term succession issues for Community. So that transaction occurred, and it was exactly as we described. Loudon's motivation, by the way, was Loudon has excess capital, and they wanted to expand beyond their Virginia base. I just saw Chris Scheib's participation in the advertisement for Brown Schultz, and he's quite correct, obviously, that they wanted to grow outside of Pennsylvania. Why that's screen's up there.
Hey Jeff, are you seeing something on your screen?
I saw something on my screen. Are you just seeing seeing my presentation?
I think I just lost it.
All right, to the back.
Okay.
Yeah.
And you hit start on it, right?
So, and the other thing that Loudon had going for it was that Chris Scheib from Pennsylvania. He's very familiar with the market, in particular with Montour. I think was where he's from, so it made logical sense. And as I said, when I described an affiliation agreement, it's exactly what it was. It was a management agreement in which Loudon entered into a management agreement to manage the insurance company and took over the board of directors of the mutual holding company. And that was accomplished, I think, at the very end of 2020, and so far so good. Now, what's interesting here is that Community had already formed a mutual holding company to facilitate a combination of Clearfield and Lehigh County, and in furtherance of one of the main reasons why people form mutual holding companies, which is to facilitate acquisitions. But here in the Loudon transaction, it sort of got stood on its head because Loudon wound up being acquiring a mutual holding company effectively by taking over the board of that mutual holding company. So that's affiliation transactions, and that's the most recent one in the Pennsylvania market. Happy to address any questions anyone has about that. But if not, we'll move on to mutual holding companies, because as I said, Loudoun community formed a mutual holding company, and that is an increasing trend in the mutual insurance industry. Couple things to note here. First of all, let's talk a little bit about what a mutual holding company is, because I'm sometimes surprised at the lack of understanding of what a mutual holding company is with some people. And it's really not all that complicated. First of all, it's a creature of statute. There are mutual holding companies statutes in 38 out of 51 jurisdictions in the United States. All the states around us, around Pennsylvania, have a mutual holding company statute except one, which is New Jersey. New Jersey has very few mutuals, so they don't have a compelling reason to enact a statute. And there are some other states that don't have it, like New York has a very limited mutual holding company law. It only applies to small life insurance companies. Washington State doesn't have a mutual holding company law. In fact, there's a fairly large mutual called Mutual of Enumclaw that its offices is in suburban Seattle, and they could not get the legislature in Washington to pass mutual holding company legislation. And so they wound up redomesticating to Oregon so that they could form a mutual holding company. So the mutual holding company form has been around for 20 to 25 years, I would say. They mostly started in the late 90s, and they're emulating something that happened in the mutual thrift industry. Mutual thrift started converting from mutual to stock form, but they had the same issues that many of you do. It's just, hey, we know we need some capital, but we don't want to lose control. And the mutual holding company concept was born in the thrift industry and then engrafted into the insurance industry. And those insurance laws were passed in the mid to late 90s. So what exactly is a mutual holding company? Well, to understand what it is, let's first think about what do mutual policyholders have? What are their rights? Basically, they have two bundles of rights. The first is obviously their contractual right to insurance coverage under their policy. But they also have membership rights. And those membership rights entitle them to do certain things. They are not the equivalent of shareholders. And you sometimes hear people say that mutual insurance companies are member owned. That's not quite right. There are rights that shareholders have that mutual members do not have, but they clearly have the highest rights of any constituency within the group. And principally what they have is the right to elect directors, the right to approve fundamental transactions, for example, that they have to vote on whether to form a mutual holding company. And they have the right to receive dividends if the mutual ever declares it, although not a lot of mutuals pay dividends. And depending upon the jurisdiction, they have the right to receive the surplus if the mutual ever does a solvent liquidation. Obviously, that's extremely rare, and this only happens in a few cases. And it's not a universal rule, and Pennsylvania happens to be one of the exceptions. Pennsylvania law says if a mutual dissolves in a solvent state, any assets that are left over go to the state. The mutual members actually don't get anything under Pennsylvania law. So what is a mutual holding company? Well, what it is it involves separating those two sets of rights, the contractual rights to insurance and the membership rights to vote on key matters. But importantly, and this is the key, it preserves these two rights. All it does is it puts the two rights in two different buckets. It takes the contractual rights to insurance and locates them in the licensed insurance carrier, which is now a stock insurance company. And it then also locates the membership rights in the mutual holding company. So from a technical standpoint, what happens is the mutual member exchanges his or her right to membership in the mutual insurance company in exchange for a new right as a member in the mutual holding company. And all the rights that they had, and this is the important fact, any right a mutual policyholder had before the formation of the mutual holding company, they have after the fact. They still have their contractual right to insurance, and they still have their membership interest. To form a mutual holding company, two things have to happen. Two approvals are needed. One, the company adopts a plan of reorganization into a mutual holding company. But two, it submits an application to the insurance department, which must approve it. And it also submits the plan of reorganization to the policyholders to approve it. And the policyholders generally need, in most states, including Pennsylvania, they have to approve the formation of the mutual holding company by a 2/3 vote. But that's a 2/3 vote of those of votes cast, subject to any quorum requirements. Most mutual insurance companies have a very low quorum requirement, seven members or 10 members or whatever. So it sounds like 2/3 sounds like a daunting task, but it's actually quite easy, because if you have 10 folks who vote and you get 7 to vote yes, you win, even if you have another 100,000 policyholders who didn't vote, and the mutual holding company is approved. Next slide looks a little busy, but it's actually talks about the 4 steps to form a mutual holding company. So what happens is the mutual adopts a plan of reorganization and forms this non-stock entity. It's a non-stock corporation in Pennsylvania, because there's not going to be any shareholders, there's just going to be members. And the mutual holding company then, in step 2, forms an intermediate stock company. That's not required, but it's almost always done. So now the converting mutual, the plan's approved, and the converting mutual that becomes a stock company now issues stock to the mutual holding company. And so for a moment in time, the mutual holding company has 2 brother-sister subsidiaries. It has the now stock insurance company, which was converted mutual, and this intermediate stock company. And then in step 4, and this is the final step, mutual holding company just contributes the stock of the insurance company to the intermediate holding company. So you have the sort of classic mutual holding company structure, which is mutual holding company as the grandparent, intermediate stock company as the parent, and converting mutual as the child. Now, the reason there's that intermediate holding company is typically if you wanted to have other subsidiaries, or you chose to raise capital, that capital would come in to that intermediate stock company. So those are the steps to form a mutual holding company. And so one of the questions is, why am I talking about mutual holding companies? And the reason is because it is an increasing trend. We have had a significant uptick in mutual holding companies. If you look at the list, and you probably can't read it because it lists all the new mutual holding companies. First of all, this is probably an incomplete list because we all have databases that we search, and mutual holding companies are still a relatively unusual phenomenon, or they were. They're not so much anymore, and it's hard to search a database to just find mutual holding companies. But this is this is probably pretty complete. And what you see here is there's 44 mutual holding companies on this list. But I think of note is that in 2021, there have already been 9 formed. And over the last, since 2017, fully 14 of the 44 mutual holding companies have been formed. And this is not complete. They're, for example, not on this list because it hasn't been completed yet, is Guide One in Iowa, a fairly large company, is in the process of forming a mutual holding company. Separately, we are aware of a company that is in a jurisdiction that does not have a mutual holding company, and it is likely, maybe not quite this year, but certainly next year, could be this year still, it's likely to redomesticate to Pennsylvania so it can form a mutual holding company. It's got some geographic proximity, and Pennsylvania made the most sense, and that's what they're probably going to do. And that's an interesting tidbit. And this goes way back from 1992. There's a federal statute called Gramm-Leach-Bliley, and there is an obscure provision in Gramm-Leach-Bliley that basically says that any company that is domiciled in a state without a mutual holding company statute that wants to redomesticate to a state with a mutual holding company statute can do so, and the state that that it is leaving has nothing to say about it. That was actually put in the law by, probably a lot of you know, the guy is now retired, Neil Menifee, who was at Rockingham at that time, and his congressman was Bliley of the Gramm-Leach-Bliley bill, and he had that inserted in the legislation. And Rockingham, by the way, has gone on to form a mutual holding company. So that's sort of the history. It's actually been used once. There was a New York company that redomesticated to Illinois using this statute, and New York, fought it for a while, but then basically let them go. And for about a year afterwards, the rest of the world acknowledged this company was an Illinois company, but New York still listed it as a New York domicile, even though that wasn't really true. So the trend is definitely on an uptick. So now the question is, okay, why are people forming mutual holding companies? Well, in this regard, there's really four principal reasons why companies might form a mutual holding company. And they're to facilitate acquisitions, create the ability to create unregulated cash flows within the consolidated group, permit stock-based compensation, and facilitate capital formation. And interestingly, when mutual holding company legislation was passed in most states, that was the stated reason why they wanted the legislation. It's actually been used for capital very rarely, but that's probably going to change in the not too distant future. So let's talk about the four reasons specifically. First, it facilitates acquisitions. Recall that when I talked about the affiliation transaction, the key to the affiliation transaction is a management agreement pursuant to which the buyer takes control of the board of the seller. And that's one of the biggest impediments to affiliation transactions. The board of the seller might like what they're doing. They might not want to lose their board seats. And so negotiating board composition is the single biggest hurdle in affiliation transactions. And the mutual holding company takes that away in large part, because what you can do in a mutual holding company transaction is you can bring a company in underneath your mutual holding company, and that can be done through them forming a mutual holding company and merging it with your mutual holding company. Or in some jurisdictions, you can actually merge directly into a mutual holding company, but that sort of defeats the purpose of what I'm saying. What you want to do is merge, bring the mutual company, the seller, under your mutual holding company, but preserve it as a separate entity with its own separate board of directors. So typically what happens is the existing board survives either in perpetuity or sometimes it's negotiated for some period of time. It's usually augmented by the appointment to one or two seats from the buyer onto that board. But that way you get to preserve the existing board and the autonomy and the name, et cetera, of the mutual. And that goes a long way to facilitating transactions. It's a strategy that's been used in the bank industry for years. Pennsylvania Fulton Financial and Susquehanna Bancorp were famous for using that strategy to buy up banks throughout the Commonwealth and in neighboring states. Now, you might say, well, gee, that's interesting. Well, it's kind of illusory. And in a way it is, because remember, the buyer controls the mutual holding company, and that now that the seller is now a sub of the mutual holding company, they're the ones who elect, that mutual holding company elects the subsidiary board. So it's sort of the best of all worlds for the buyer. They can offer autonomy and keep everybody around, et cetera. But of course, if things aren't working out, or for whatever reason, subject to any contractual agreement that they made, they can just replace the board with all of their people. So it's an effective device for the buyer. It is, from the seller's perspective, if you trust your buyer or you get a contractual commitment that they're going to keep the board in place for 3 years or 5 years, et cetera, I think you're fine. But it's not. The autonomy feature is not. It's not perpetual, and it is not complete. The other thing the mutual holding company doesn't do is it doesn't preclude affiliations. You could still do an affiliation with a mutual. You could, for example, Donegal is famous for doing it this way. They will do affiliation transactions, and particularly with some distressed companies. And what they do is they sort of rehab the company, and then sometimes, in the past, what they've done is they've contributed it to their downstream stock company. It's actually a great device for them to alter their pooling arrangements and hopefully help their stock price. And they've used that technique for a number of years. And the other thing you can still do is you can buy a stock company. It's a little difficult to buy a stock company underneath an insurance company. You can do it, but it is not common. The mutual holding company structure allows you to buy a stock company and, again, keep that as a separate subsidiary and give them autonomy. So that's the first reason why companies might form a mutual holding company. The second is probably not as obvious and not as stated as often, and that's to create unregulated cash flows. Every dollar that comes out of an insurance company either has to be fit the distribution rules, or it has to be an extraordinary distribution, which requires insurance department approval. Once you form a mutual holding company, you can create an agency or an MGA or a data processing company or an analytics company, or increasingly a management company as a brother or sister of the licensed carrier. And any revenue that flows into that company is largely unregulated. You can do with it what you want. And you don't need department approval to move money around, say up to the mutual holding company and down to another subsidiary, et cetera. So it can be a very effective tool. And there are some mutual holding companies who definitely use this structure. So for example, there's a company in North Carolina called Medical Mutual of North Carolina. It's a med-mal carrier. It has tons of excess capital, been a very successful company. And its CEO, background, he was one of the big four in one of the big four accounting firms, and he had a lot of real estate clients. And what they did is they dividended $200 million of excess surplus out of their licensed carrier, because I think they write about 100 million and they had 600 million of surplus. They took about $200 million out and put it in a separate subsidiary, and they do real estate development in that company. And they've done that successfully. Another example right here in Pennsylvania is the Contribution Ship in Philadelphia. They formed a mutual holding company because they had a subsidiary that is a security company, and it actually had grown so large that it actually exceeded the investment limitations for insurance companies under Pennsylvania's law. So they had to form the mutual holding company and move the security company out from under the contributionship. So now it's a brother-sister company with the contributionship and a sub of their mutual holding company. Third example is Trustmark, a fairly large life company in suburban Chicago. They offer traditional life, including mostly group life and voluntary benefits, but they have a lot of health and wellness subsidiaries that provide fee-for-services to their clients, and those are in separate subsidiaries. So it can be a very useful way to generate unregulated cash flow. Third reason is stock-based compensation. As a mutual, you don't have any stock, so you don't have the ability to offer stock-based compensation to your directors, officers, or employees. Once you form a mutual holding company, you've now got a stock entity, the licensed carrier, and most typically an intermediate company called that is also a stock company. And you can now create stock-based compensation. And I want to emphasize that doesn't require you to do a stock offering. You can instead of creating Farnam plans or stock appreciation rights, something that are Farnam and aren't really stock, you can create real stock-based compensation. You can give people options. You can grant restricted stock. You can, and one of the things you can do is form an employee stock ownership plan. An employee stock ownership plan is a broad-based tax-qualified plan, and it has to include all your employees. So if you were of a mind to say, okay, we like mutuality, we want to stay mutual, but we would also like to reward our employees and create and align their interests with the goals of the company, then what you can do is form an employee stock ownership plan. Now, we spend hours on how to do that and why you do it and the different features of an ESOP. That's a conversation for another day, but it has historically been a very effective way of aligning the interests of employees and the corporation's goal, because the value of the stock goes up as the company succeeds, and therefore the employees see in their retirement accounts the increasing value based upon performance of the other company. You can also then do stock options and restricted stock. Stock options are just what they sound like. You grant the individual a right to buy the stock at a given price called the strike price, and they make money if the stock value goes up and they exercise that option. Now, when they exercise, usually what they do is they exercise it for the spread between the market value at the time of exercise and the strike price. That is, and it's because there's no liquid market for the stock. That's the typical way these things are settled, but don't have to be. And restricted stock is just free stock granted to the recipient that usually vests over a period of years, generally 3 to 5 years, and both stock options and restricted stock, in particular restricted stock, are frequently performance driven. So you might get a baseline of options that are just, you just get for existing, but frequently what happens is you earn options or restricted stock based upon performance over, and that's typically over a 3, maybe 5-year cycle so that you're not focusing purely on short-term results. Some examples of companies that have used their stock companies to provide stock-based compensation are Bella Mutual, which is about a $600 million surplus company in Boston. They have a stock company, and they grant stock-based compensation to their employees, and they get their plan valued every other year. Caddick Financial is a title company that's in Connecticut, and they just instituted stock-based compensation in the last year. And Norfolk and Dedham Group, although it's not a mutual holding company, it has some features like it has a downstream management company, and they grant stock-based compensation in their downstream management company. So that's the third reason why they might you might form a mutual holding company. The fourth reason is the one that, as I said, was the articulated reason for why most people formed mutual holding companies, or said they wanted to form mutual holding companies, why the legislation was passed, but has not been used very much. And that's to facilitate the raising of capital while preserving mutuality. And that's the key here. The mutual holding company, the actual definition of a mutual holding company is a company that has a stock subsidiary insurance company, and in which the mutual holding company controls the majority vote. And so as long as you control the majority vote of the insurance company, you are still a mutual holding company, and you're still a mutual because your mutual members still control the board, etc. To date, a long time ago, there was a life company called Analyst that raised capital using a mutual holding company. The only one that's done it recently is a company in North Dakota called Nodak Mutual. It was the Farm Bureau company for North Dakota. And it formed a mutual holding company and offered stock in a public offering first to its policyholders and then the public. They sold a 45% interest in the company. They raised $103 million. They actually had orders for $250 million of stock, so they were wildly oversubscribed. And they've been a mutual holding company with a downstream, with an intermediate stock holding company, 45% owned by their policyholders and investors since 2017. Actually, it's almost exactly 4 years this month. It was March of 2017 when it closed. And I think they intend to stay a mutual holding company for the foreseeable future. Interesting feature of that plan was that they also distributed cash to their policyholders. They gave them all the right to buy stock, and if they didn't want to buy stock, the subscription rights that the policyholders they could put back to the company, and the company paid them cash. So every policyholder of Nodak either bought stock or got a check for about $250. A relatively unusual feature. There's another company in the Mid-Atlantic states that is actually doing the same thing, and there it's much smaller policyholder base. Policyholders are going to get checks for $1,600. The other thing that the mutual holding company does, from your perspective, is it gives you the ability to access capital quickly. Mutual holding companies statutes do not require you to sell stock to your policyholders, and they do not require, and this is key, they do not require you to do a public offering. You can raise the money privately. And if you wanted to raise capital privately, that's a much quicker process than the process of going through the SEC and raising capital publicly. And it's particularly important if you want to do acquisitions of stock companies or otherwise. I've been in this situation several times, a couple of times on the sell side, a couple of times on the buy side, and it goes like this. So there's a insurance company that becomes available for purchase. They've hired an investment banker to run a process and seek a buyer. And they go out to a bunch of companies, and you look at it and you say, this is a great opportunity. We'd really like to do this. But we don't have the capital to do it. And so the letter you send in will say something like, we'll pay X dollars for this company, but we have a financing contingency. We have to form a mutual holding company and then go raise the capital, and that's going to take us at least 6 months, it may be longer. I guarantee you that if there is a competitive process, you will, if you're the wannabe buyer in that case, you will lose in that process every time. Because if I'm the investment banker on the sell side, I look at that and I say, way too much execution risk. Who knows what can go wrong over the next 6 months to a year. We've got buyer B sitting over here that has the capital and can do the transaction now. So one of the reasons to form a mutual holding company is to put yourself in a position to raise capital quickly if you need it. Even if you don't want to raise capital now or don't have the need for capital, positioning yourself to raise capital quickly if you needed it is helpful, and the mutual holding company facilitates that. Lastly, I want to talk a little bit about mutual holding company capital funds. There is a move afoot, and we're involved in it to some degree, about forming a fund that would provide capital to mutual holding companies. Historically, mutuals have a lot of trouble raising capital. They basically have three ways. They either make money and add surplus, obviously that's the best way. They effectively rent capital through reinsurance, or they issue surplus notes. Well, the second way, renting capital through reinsurance is fine, but it's a little bit like a treadmill. Once you're on it, it's hard to get off of it. Second, and the surplus note market is thin, very episodic, and in general is limited to companies that are highly rated. So not a lot of options for mutuals to raise capital. And now mutual can demutualize and raise capital, but for a lot of good reasons, mutuals don't generally demutualize. They value mutuality as well they should, and they don't want to be in a position where they risk loss of control. A lot of these companies have been around for 100 plus years, and there's some legacy value there, name value. And in most demutualizations, you wind up having to do an offering to all your policyholders, and as a result, you are by definition a public company. And most people don't want to be public companies for very good reasons. The mutual holding company, however, allows you to say, in theory, says, okay, but we can form a mutual holding company. We can keep control. And you just told me you can do this as a private placement rather than a public offering, so I don't have to be a public company. And that's true. But even then, your options are not plentiful. You really have two options at that point. Private equity, they'd be very interested in being the capital provider to a lot of mutual companies. But it's probably an understatement to say that the gulf between the mindset of mutual board of directors and management and pure private equity is pretty wide. Private equity, they'll want board seats, they'll want some say in managing the company, or the direction of the company. And inevitably, most fundamentally, they need an exit strategy. And their ideal exit strategy is always going to be to sell the investment, which is, of course, completely antithetical to what the mutual holding company is designed to do. The other option is do a minority public offering. But again, you can do that. That's what NODAC did. But you've done a public offering, and now you've got public company reporting responsibilities. There's a move afoot to create something that hopefully bridges the gap. And that is to form what's called, what is basically a private fund that would sort of sit between the investment community and the mutual holding company. And they'd raise money primarily from other mutuals, aggregate the money, and then invest it on mutual friendly terms in mutual holding companies, usually in the intermediate holding company. The goal is to raise about 100 to 150 million. That would give them the ability to do 5 to 7 or 8 transactions in mutual holding company transactions. And the key here is they can provide a good return to their investors without requiring the sale of the underlying mutual investments in the mutual holding companies. And that's the key. The whole goal of this fund is to sort of sit between the private equity world or the stock investor world who needs a liquidity event, and the mutual holding company who might very well welcome the capital on friendly terms, but doesn't want the exit strategy to be the sale of their company. And that's what this fund is designed to do. I think you're going to hear more about this in the next few months. And hopefully it presents an opportunity both for mutuals who want capital and frankly mutuals who view it as a opportunity to deploy some capital to help the mutual industry and earn returns that are significantly better than you can earn buying T-bills. That's what I have for you at this point, Tim. I'll be happy to entertain any questions at this point, and otherwise, 10 minutes early, people can get to lunch.
Yeah, thanks, Jeff. Question about, you talk a lot about the county mutuals. Do you see a trend, for example, in the discussions they're having with the rating agencies? Do you see, when they look at diversification, a lot of those started out as property only type of companies. Is that an area where they're getting some pressure, if you will, about diversifying either in other counties or other states? Is that a driver for some of them?
The driver for things like forming a mutual holding?
Yeah, exactly. Driver to do something else so that they're, if they did get hit with a storm that hit their area, that, it takes their reinsurance and takes their line of credit at the bank, they need to do something else. Is that something that you're seeing?
Absolutely. I can think of a few companies who form a mutual holding company, not just for some of the reasons we outlined here, although one of them is affiliation. They want to do it in part so that they can affiliate with a company in a different geographic market. For example, cat exposed companies. I can think of one company in particular. It's in Kansas. It's probably going to form a mutual holding company with the express purpose of diversifying and affiliating with some other companies with whom they're familiar in the western states to diversify they've got a lot of hail and tornado risk now, and they want to diversify out of that. And also to diversify lines. So, for example, Nodax Mutual Holding Company and its acquisition, it was historically, 95% 95% personal lines. And since they've done their MHC formation, they bought a non-standard auto company, which is still personal lines, but a very distinct line. And they bought Westminster American down in Maryland, which is 100% commercial. And in fact, one of their stated goals of forming the mutual holding company was to have capital to buy commercial companies because they knew they needed to diversify their lines of business.
Interesting. Thanks. I didn't see any other questions in the chat. Does anyone have a question for Jeff? Or if not, as Jeff said, we can proceed. Just give him a second here, see if anyone types anything in here, Jeff.
Sure.
Yeah, I don't see anything coming through the pipeline. So with that, I wanted to thank you, Jeff, for your informative talk on this important topic and explaining a lot of the terms. As you said earlier, a lot of us, will use terms interchangeably, and they're not necessarily the correct ones as they're describing these transactions. So I thought it was very helpful, walking us through all the steps, and your slides have followed. So thank you very much.
Appreciate the opportunity.
Yes, and again, if people have questions for Jeff, after this, I'm sure if you don't have his information, we'll make sure we get that to you, so you can get your questions answered directly. So this concludes our morning session. And again, thanks, Jeff and Griffin Financial for participating today. We will resume after the lunch break. Normally, we're about finishing about, say, a little more than 5 minutes. So it goes to 1 o'clock. So sign in about 5 minutes till. and it will be the extreme weather session from Guy Carpenter, in case you're wondering what the next one is. And keep in mind that on the Zoom, the way we have it set up with PAMIC, there's a link to the afternoon session. So we'll actually be signing off the current link that we have, and that was sent to all, or will be sent to all people who have registered for the event via email. And if for some reason you don't have it, Brittany has left her email address here, which is bmlynek@pamic.org if you have any issues. So we can log off now, and we'll see everyone in about 45 minutes for the afternoon session on weather with Guy Carpenter. Thanks again, Jeff, and talk to everyone soon. Bye.